Rightio, welcome back to the Williams Real Estate Channel. Today we are discussing house versus a unit. The good old debate. What's better? There's pros and cons with each type of asset. Houses and units, they both work well. I've got them both in my own personal portfolio. I buy both houses and units. I don't just say stick to houses or stick to units. It's always good to diversify property types because every type of property at some point will have its time in the sun and outperform. As an example, over the last 5 to 6 years, houses in the regions have taken off, but over the next 10 years, they probably won't do so the same growth that they've done in recent years. They'll probably go through a more stagnant period like what happened from around 2008-9 through to 2020, where they were pretty subdued in the first half of the current cycle. So pros and cons, we'll go through the pros and cons of a unit versus a house. And then we'll also discuss at each of the listeners, I guess, if you're listening along, where in your own portfolio will a unit help more so than a house and vice versa. So starting off with a house, the benefits for a house, obviously you have that larger land holding component. Some people say houses have better growth over the long term. I don't agree with that. I would say houses have more stable growth. They don't go through significant booms and then slowdowns like what units do. They tend to just tick along. So they have more stable growth. You've got a larger land holding component, so you can pick them up between 600 meters squared. Ideally, when we're buying a house, this is sort of minimum. We like to pick them up minimum 600 because you can build a granny flat or subdivide it into two with around 600, general rule of thumb, depending on each LGA and council, but you'll have that development upside. Or if you can go up to even 1,000 squares for a house, you can at some point knock it down and build 3 or 4 townhouses. So it has that development upside definitely for houses versus a unit. Obviously, the only value add to an individual unit is stripping out kitchens, bathrooms, such thing. You can't add development to an individual unit as you're tied up in a strata complex with other owners. You can convert a unit from a 1-bedroom into a 2-bedroom if you get those larger old school flats that you can get creative by taking out a wall or two and putting a couple extra stud walls in to convert it. So that's an option for units. But back to houses, so they have more stable growth over the long term. They have a larger land holding component, so yes, you have that development upside. The pitfalls with houses though is they come with a larger price tag. So in the regions between 250 to 450K is the price tag in the regions. And in metros, I mean, you can still source deals for around 600K to, I mean, 2 or 3 mil plus in the likes of Sydney, Melbourne, and even Brisbane. The large metros, they get a bit exy. So when talking houses, we buy houses typically only in the regions because the yields are there. If you're buying houses in the metros, the yields are very low, so they don't quite work if you're looking to build a portfolio. So something to think about. They will hold you back in terms of your finance because they have a lower yield. So the yields for a house between, I mean, if you're spending over couple of $1 million, could be between 1 to 2%, especially in the likes of Sydney. But you can still get yields around that 3 to 4% in the metros. When you go out into the regions, you can get higher yields of between 6 to 8%, depending on the market cycle and the timing. That's why we tend to buy houses in the regions and not in the metros. We typically stick to units in the metro markets. So they do come with a lower yield, higher price tag. So typically you'll need a larger deposit and you get a high price point. So they can eat into your capital. So it can eat into your borrowing power, your borrowing capacity. It can use up a lot of borrowing capacity of your house versus buying a unit, especially when you're starting off and you need a decent sized deposit. So something to think about. Another thing that I find is quite missed in the industry, which people don't appreciate of and understand between a house and a unit, is when you buy a house, the banks will factor in a higher risk profile or assessment of buying a house. If the roof needed replacing, that could cost anywhere between 60 to 100,000 to replace, depending on the size of the roof, depending on the material, if it's ColourBond, cheaper, if it's clay tiled, or if it's slate, that can get quite expensive. So, but generally speaking, for a 3-bed, anywhere between 60 to 80,000 of cost would cost to replace the roof. So that's a risk. Same goes for plumbing. So when you buy a house, that's all on one owner. Versus if you buy into a complex of say 10 units and the roof goes, that could be between 100 to 150K for the roof. But as they split across multiple owners, 8 to 10, 12, 15 owners, that risk, that maintenance upkeep cost is reduced because it's shared around all the owners in the complex. So when you're buying a house, your serviceability won't go as far as if you're buying a unit, villa, townhouse in a complex, because of the maintenance upkeep cost risk is all on one owner. So that's something to think about. So they can be lumpy. Yes, you'll get stable growth, but it will make it hard, typically hard to scale a portfolio if you just stick to houses. So they can create good equity in your portfolio over time, but they can also hold you back in terms of your serviceability. When talking about units, obviously entry-level stock, they're great. We're picking them up between 220K to about 450K in metro markets. So well under replacement value. It costs minimum 600K to build a unit these days. So we're buying them for at least half, if not a quarter of the replacement value. They come with really good yields between 6 to 8%. So that's the rental income, the rental yield. The rental yield, strong. So price point, you don't need much capital to get into them. So as you can see, with this price tag, you can buy 3 or 4 individual units, villas, townhouses for the price of one house. So you can get into multiple markets, you can diversify, you can get a solid cash flow. The banks love them. They would love you to just continue buying these types of properties every day of the week, because they've got strong cash flow, and also you're minimizing the risk of maintenance upkeep with all the other owners in the complex. So diversification is key, not only in each market, but also in the complex is good. And then the banks will then allow you to keep borrowing more money, to keep buying more and reinvesting into each market. So units, the downfall of, I guess, unit is they have that limited value upside in terms of development upside. If you time them well though, and you get in early into a market cycle, you can easily double, if not triple your money. We're buying units, villas, townhouses for 150 grand to 200 grand in Brisbane, half an hour south of Brizzy, between 2018 to 2021. These days they're all going for 480 to 500,000. So they've 3x, doubled if not tripled in value within a 5 to 6, 7 year window. So the deals we're buying today will do the same, because it's all about the price you pay relative to the build cost. Cost minimum 600K, minimum 600K to build. So we like buying them between 200 to 450K, because it's only a matter of time the price you pay will realign to the build cost in a more balanced market. And then when the boom sets off and all the stupid money is pouring in, like what's happening into Brisbane, Perth and Adelaide now, that's when the price will exceed the build cost. That's when developers start building again, releasing new stock onto the market, new and off the plan. So that's the type of stock that we don't suggest buying, is new and off the plan, because by the time a developer is releasing new and off the plan type of stock onto the market, you already got your market selection wrong, because typically developers will build into a booming market when it's feasible and it stacks up. And if you're buying into a booming market, you already missed the boat. You've got that market selection wrong. In order to get deals within this price bracket, you have to look for the more suppressed markets with the higher yields very early on before the growth cycle starts, and not towards the tail end of a boom in new and off the plan stock. So when you hear the stories around don't buy a unit, they don't grow in value, 9 times out of 10, those types of people have bought peak market in a new type of property, overpaid the build cost, so spent $800-900 million on an apartment in a booming market prior to its downfall or a downturn, and then being left hanging for 10-15 years until the next bull run to get any substantial capital growth, and even being left hanging in negative equity for a number of years. So market timing and market selection and price point is crucial when buying units. It's not every apartment will work. It's all about the price you pay relative to its intrinsic value. When we're talking property, it's how much it costs to build. And it's always a moving target. So units versus houses, if you can gather, they both have their pros and cons. It's all about which type of asset in the current market, being 2025, is providing the best value for money, and how far does your money go? Between 2018 to 2021, houses had great value in Brisbane, regional Queensland, New South Wales, Perth, Adelaide. But because the prices have risen so high now, the yields are suppressed, the value isn't there. So I don't suggest going and buying a house, especially in 2025, because you'll pay a premium. You'll more than likely have a very low yield of between 3 to 4%, which is a bad rental yield. You need at least 5%. 5% yield, or 20 times earnings, so 20 times the annual rent. So yearly rent times the yearly rent by 20 will give you the value of a property based off its earnings, also equates to a 5% rental yield. 5% is fair value. When you buy a property with a 3 or 4% yield, the price you pay is overvalued relative to its earnings. When you get a property with a 6 to 8% rental yield, like what we do every day of the week, that is good. The price you're paying for that property is undervalued relative to the earnings. Rents rise first, yields then become attractive, prices then follow. So rental yield is a key indicator for price growth, and that's a moving target. Right now, houses yields are very low because prices have exploded over the recent years. Value is now screaming in certain markets in units, villas and townhouses. However, in 5 years' time, all these apartments and units that we've been buying will easily double, and then they'll compress the yields to 3 to 4%, and then the values won't be there in units, villas, townhouses in metro markets anymore. We'll most likely be out into the regions picking up deals with solid yields when those rents rise. So it's always a moving target. It's always about the price you pay relative to its intrinsic value, having a strong yield. And if you can overlay the market cycle with the 18-year land cycle and historical sales data, it'll guide you into the direction of whether you should be buying a house in 2025 or an apartment in 2025, because it's always a moving target. There's not one that is better than the other. Units are great. They're like kindling to your fire to either start your fire going, start building your wealth. And then houses are good to then start loading on when the timing's right and the value's there to get your wealth to that next level. That can be also supported and supplemented with strong yields out of units to reinvest that into houses to balance the earnings, because you don't want to stack a portfolio just with houses, otherwise you'll get stuck easily with 2 or 3 properties. And then it's also good to come back when the yields are there and the value's there and stoke up your fire with more kindling and add some more units into your portfolio. This is what I'm looking to do now. I'm looking at this stage where the market's at in 2025. The value is individual units, villas, townhouses. Won't be there for long, probably another 2 or 3 years, and then the market will shift come the end of (2026) peak market to 27. So 2026 will be peak land market, 2027 will be peak stock market. Come 2028, you'll know about it. It will be like the next equivalent to 2008 on steroids. Every second one's a big one. And when the market does turn, we're right here now. We're in the final quarter where Brisbane, Perth, Adelaide outperform historically. In the first quarter, Sydney plus Melbourne outperform. So Brisbane, Perth, Adelaide, and their respective regions are all going gangbusters now, because we're in that second half of the 18-year land cycle. Now, if you don't believe me, run the historical sales data reports and look what happened from 2000 to 2007. Brisbane, Perth, Adelaide and their respective regions took off. Come 2008, they switched off and went the other way. And then when the mainstream herd finally realises it's no longer a good idea to keep buying in these markets, that demand will shift back to Sydney, Melbourne. In a time of crisis, in the next GFC, which is going to be like the GFC on steroids, people won't be able to hang on to the big shiny house for 1 mil to 3 to 4 plus mil. So all the people now that are overextending themselves into houses, we'll be letting them go if they're owning it or renting it. And what they'll be doing is they'll be flooding back into affordable stock apartments. So even when we're due for the next land-driven downturn, come later decade, the demand will shift back to Sydney, Melbourne in affordable stock. So the bottom end will rise, entry-level stock, units, villas, townhouses will rise when the top end of town's coming down. So commercial real estate, historically, in the later stages of the cycle, when we go through land-driven downturn, historically loses between 50 to 70% in value, especially if it goes vacant and you've bought peak market off a cap rate and it goes vacant, it'll be worth land value. That's commercial. High-end real estate, so all the mansions, all the big shiny homes, blue chip stuff can lose 20 to 30% value. So the houses, it's all timing. This is all critical timing. Everything works well, houses and units, however, it's timing. And right now in 2025, alarm bells are going off. In 2025, it's no longer a good idea to keep buying into the big shiny blue chip type of stock, new and off the plan stock, commercial stock, big shiny homes, because when the market turns, that type of stock historically gets absolutely hammered. But we are in this supposed housing crisis and everyone needs a roof above their head. So when the demand shifts, when all the mainstream herd finally get the light that it's no longer a good idea to keep buying in these markets, they'll be rushing back to Sydney, Melbourne, just like what happened from around 2007 and 8. Sydney and Melbourne will lead in the recovery, but not every type of stock. It will be the entry-level type of stock. That stuff will be rising and will easily hit the replacement value and go above it, 600-700, because the demand will shift to that bottom end. The government, the RBA will drop rates back to near zero again. They'll print money. That all feeds into asset values, into the property market. It won't be enough to save the top end, but it'll all feed in the bottom. The government, federal government, will also typically come up with new packages for first home buyers, no money down, 1 or 2, 3%, 5% deposits, or they'll come up with some new scheme to help first home buyers to keep feeding them in to the property market, to keep it buoyant, to keep it going. That all feeds into the bottom end. So the bottom end rises in times of crisis when the top end's coming down. So yes, we will be in a technical downturn, but it will be driven by the top end of town, houses, big houses too, and the entry level stock will be rising. So it's always a market, there's always a time throughout the market cycle to either get into a house or an apartment. And it's also to your personal situation. So when starting off, I suggest get into a unit, villa, townhouse. You don't need much cash. I mean, you can get into them with 50 grand cash, 200,000 borrowing capacity, you can get in. You get good solid yields, 6 to 7, 8%. Once you get a bit of roll on when the market's timing is right, then add a couple of houses. I wouldn't say just stick to houses. Then once you've into a couple of houses, then look at a duplex, and then ultimately you want to land in blocks of units. Blocks of units is the best of both worlds. You get the whole land holding component, you get a solid cash flow, you get development upside, you can strata title. It's the best of both worlds. Ultimately, you want to land in blocks of units. But also, in terms of market timing, where we are now in 2025, the best value is in units, villas, townhouses over houses. Houses have had a solid run in recent years. Yields are compressed. Values aren't there. The market will recalibrate in time and they will come good again. But in terms of today, I'm seeing the best value right now in individual units, villas and townhouses for starting a new portfolio or giving an existing portfolio a hit of nitrogen. You really can only get better value if you go into blocks of units between that 1.5 million to 3 million mark. Once you go above that entry level commercial stock, because that's where a lot of demand's going in now, as people are chasing yield, typical point of the cycle where we are, in the final winner's curse land boom, people chase yield as yields get compressed in residential houses, so they're chasing that entry level commercial stock. That can be a bit dangerous now at this stage, especially if you're getting into something like that with an average yield. You have to go above that to around that 1.5 to 3 million. So blocks of 10s plus, great value, because there's not many buyers or players in that market. So the value's there, and or individual at this stage of time. So personally, I'm looking to continue to keep stoking up my own existing portfolio in individual. It's always good to diversify. Selling out of Queensland and Brisbane in the next 1 to 3 years. I'm going to wipe the floor with Queensland and reinvest it into Melbourne, Sydney and regional Victoria for the future years ahead in both individual units and blocks of apartments. Hope that helps. Catch you next one.